Good evening. So today our lesson is venture valuation. So at the very beginning, I will discuss about why do we need to value a venture. So what are the requirements to value ventures, and thereafter we will discuss what are the context specific issues of venture valuation. What are the special problems that we would face as an analyst when we are valuing ventures? And thereafter, our discussion will be focused on the different venture valuation methods and how to determine the value of the venture. So you all have already learned how to value a company, a corporation. So likewise, there are different methods of venture valuation as well. So normally we can use discounted cash flow method. Apart from that, the venture capital methods and even relative valuation also we can use to value ventures. So we will discuss about these methods at the latter part of the lesson. So moving on. So why do we need to value a venture? Why do we need to value a venture? So the first thing is, as any other organization, any other business, venture also should create value throughout its life cycle, right? So value, it represents, it is an indicator of the venture progress. So normally at the very initial stages like development stage and startup stage, the value of the venture, the quantifying the value of the venture might be difficult. But the venture value, it reflects actually the progress or the success of the venture. So it is the future potential, the value, it represents the future potential of the venture. So even for entrepreneurial venture, we have discussed that the objective is to maximize the wealth of the owner. So in order to identify what is the value, whether the venture is creating value for owners, creating wealth for owners, we should know, we should determine the value of the venture. So value is an indicator of a venture progress. And then the second point, the financial decision making. So normally, so there is sound problem. Right? How about now? Still it is not clear. So still the sound is not clear. Oh, so I will explain. If the sound is not clear again, uh, tell me through the chat. Right. So, so I would explain the second point, the financial decision making. So normally for ventures, uh, if they want an intervening financing, then we need to assess the value of the venture. So that means, let's say if someone wants to join to your business in the midway, and if you want to decide what is the percentage of ownership that you are willing to give to that investor, so we should know what is the value of the business now. Okay. So that type of decision, especially for the intervening financing decisions, uh, the value of the venture should be decided. in order to decide what is the percentage of ownership that the venture owners are willing to give for a new investment. And then the planning for harvesting. So harvesting is like a process of selling the ownership of a privately held venture to realize its value. So normally at the maturity stage of a venture, uh, the owners would think about these turnaround strategies. Either they would go for an initial public offering, or they would sell their ownership through an outright sale. So in order to do that, we need to know the value of the venture. So in order to distribute the value of the venture among the investors, first we need to estimate the value of the venture. So when we are planning for the exit strategies, the venture valuation is important. So still sound, what about the sound? Still it is not clear. Still sounds are not clear, or it's clear? Let me give me feedback through the chat. Right, it's clear. So then, moving on, does the past matter? So I will explain this through this illustration. So here, a Kasun, owner-manager of small restaurant in Kigol, has started his business 1.5 years ago with 500,000 investment and worked 70 hours a week throughout this period. That means he has worked 70 hours a week for 1.5 years. And he has worked as a worker for a restaurant earlier and received a wage of 150 per hour. The success of his innovative dishes has recently drawn investors' attention, and he has direct offer to invest 1 million for the business. So after calculating his cash and his effort to the business, he has decided to give 43% of ownership to the new investor. Right. So let's see how he has decided this 43% of ownership. So this is an example of the second point, that financial decision making. I talked about how to decide. So the venture valuation is important when if someone else wants to join or invest to the venture at the midway, and then you need to decide what would be the ownership percentage that you are willing to give for that person. So if we take this example, let's say, so he has determined this value based on his cash and his efforts. Right. So here, so he has invested at the beginning in cash 500,000. Right. And if we want to value his effort, the time that he has spent for the business, so the opportunity value of his labor was given, right? So if we assume, let's assume that there are 52 weeks for 1 year, then 1.5 year means 78 weeks, right? 78 weeks, and for 1 week he has worked 70 hours. he has worked 70 hours for 1 week. And throughout these 1.5 years, he has worked 78 weeks. And for 1 hour, earlier he has received 150 rupees per hour. So what is the opportunity cost of his labor, efforts? Opportunity cost? What is the value? Yes, 819,000. So the total value, so according to his approach, the total value of the business is equal to 500,000 plus 819,000. So that would be 1,319,000. Right? And this new investor, he is willing to invest 1 million. So before the investment, value of the venture is equal to 1,319,000. And as a new investment, 1 million would come. So after the new investment, value of the business would be after the new investment, it would be 2,319,000. Right? Now, based on this value, we can calculate what is the percentage of ownership that we can give for the new investor. So after the new investment, total value of the business is equal to 2,319,000 and the new investment value is equal to 1 million. So ownership percentage we can calculate it by dividing new investment, dividing the new investment by the total value of the venture after the new investment. That would be equal to 43.12, right? So that this is how this person has calculated the ownership percentage to give for a the new investor. So that means if the new investor is willing to invest 1 million in his business, he would give 43.12% of the ownership of the venture to that new investor. But the question is whether this approach to value a business is correct or wrong. Whether the approach, his approach to value the business is correct or wrong. So tell me whether this approach is correct or wrong according to your opinion. So give me the answer through the chat. Does this ownership percentage is correct according to your opinion? Especially valuation is all about future, right? not the past. So this approach is incorrect because basically the value is not directly related to the quantity of the past effort in cash or in sweat. So these physical efforts or mental efforts for the business is called the sweat equity. So, so any kind of past efforts will not be considered in in valuation, because in valuation we are trying to quantify the future. So that is why, so the value of the venture is not directly related to the quantity of past efforts in cash or in sweat. So that means, so this sweat equity, the concept of uh, sweat equity is that your skills, efforts, or your time that you have put into the business is called sweat equity. So it is a work-related activities, but the owners does not receive any financial compensation, any financial reward for those activities. But those activities have been contributed to increase the value of the business. So work-related activities, but owners does not receive any financial reward, and those activities should be contribute to create or increase value to the business. Then those type of activities are considered as sweat equity. If we take, for example, what is the sweat equity value in the previous example? In the previous example, sweat equity value, that would be equal to the 819,000 of his labor, right? His compensation for his labor, right? So, so counting for the past is all well and good. An investor seeks to quantify and value the future. So as I have told you, past efforts lays the path to the successful business. Actually, based on the past efforts, uh, it will impact to the success of the business. Like, for example, the product development, then building a brand name is very important for the future of the business. So these past efforts are indirectly related to the value of the business, but not directly related to the value of the business. So investors are ready to pay for the future. So therefore, the venture valuation, we attempt to quantify the future of the business. But the future of the business is built upon the past efforts. So indirectly, past efforts would affect the value of the business, but not directly. Right. So what are the issues of venture valuation? The specific issues of valuation, especially in the context of ventures. So the first issue is absence of historical data. So most of the ventures, they have very short history, most probably 1 or 2 years of operating history. So the data availability about the operating activities or financing activities is limited. So in valuation, we know we need to estimate the growth rates, we need to estimate the discounting factors, what are the risk parameters. So these estimations are very subjective because of the absence of historical data. Like apart from that, it is very difficult to estimate these variables because it can have a significant changes over the time as well. Say for example, let's say the working capital requirements of the venture can dramatically change based on the demand for the product. If the product has high demand, there will be no need of working capital. But low demand, then there will be very less demand for working capital. So these variables will fluctuate from year to year with some uh, the factors from business performance, or it will be affected by the factors in the environment. So if the company have past data, we can check the reliability and the reasonability of our estimation. But without historical data, so we have to make judgments. So it is very difficult to make such judgments with little information. Right. Moving on to the next point, the major issue then we have faced in venture valuation is that sometimes there will be very small or no revenue, or there can be negative earnings. Uh, because these ventures, they have little operating details and they have lot of expenses, especially when it comes to establishing the venture. First they have to establish the venture and their products in the market. For that they have to incur a lot of expenses. Therefore at the initial stages there will be a lot of expenses than the revenue. So this will result in negative earnings. So when venture have negative earnings, in valuation there are some measurement problems, especially when it comes to growth rates, like when we are estimating the historical growth rate. So if we are calculating the growth rate using these negative earnings, then the growth rate would also be a negative value. So if we apply this negative growth rate for future revenue, it will make it a more higher negative value, which is not meaningful in our valuation. And so when estimating growth rate, it is very difficult to estimate the growth rates, the meaningful growth rate when we have negative ones. And then the second point is the going concern assumption. So in valuation, we always assume that company or the venture will operate for unforeseeable future. So that is why actually we are dividing the forecasting period as explicit period and the implicit period. But when ventures have negative earnings, so there is a high possibility that venture will fail or not sustain in future. So which violate our assumption of the infinite lifetime. So we cannot estimate, especially the terminal value. So when we are estimating terminal value, we are assuming that venture will operate for unforeseeable future. But if venture is generating negative returns over the period, then we have doubt whether it will sustain for future. Right. Then the next issue is illiquidity. Venture mainly depends on the private equity. Venture depends on the private equity, and especially the seed finance is mainly provided by the owner or the family members or friends of the owner. So these investments are much more illiquid than the investments in the publicly traded companies. So it is very difficult to estimate this illiquidity factor and include it in our discount rate. So when we are deciding the discount rate for the to discount the cash flows, then we have to consider this illiquidity factor. But it is very difficult to measure this illiquidity. Therefore, the adjusting the discount rate for illiquidity is also difficult. And when it comes to the survival, so we have already somewhat discussed this point. So most ventures don't survive until it becomes mature, and the failure rate of the ventures are very high. So this impact on the assessment of the value of the business, because the larger proportion of the value of a firm, larger proportion of value of a firm will depend on the terminal value. So therefore, when we are estimating the terminal value, we have the assumption that venture will reach to a stable state, and thereafter it will continue for foreseeable future. So it is a prerequisite for estimating the terminal value. So sometimes it is not true for ventures. So when will firm when the firm will be stable, and the probability of the survival is very critical, are very critical inputs to valuation. But calculating this aspect and practicing this in the valuation is difficult. And then the last point is absence of comparable firms. So if we are using relative valuation, so finding a comparable firm might become difficult when it comes to ventures. It can be challenging to find a similar type of firm. So normally, if the venture is kind of very unique, innovative type of venture, then even the relative valuation approach will not be suitable to value the venture. So those are the major problems, issues that we will face in venture valuation. Right. Then we will discuss about if firm had negative earnings, how we are going to deal with this negative earnings in valuation. So in order to overcome this problem, we have three methods. One is we can normalize the earnings. So normalizing the earnings means we can replace the current earnings, which is a negative value, with a positive normalized earning. So that means we are taking the earnings value. So what would be the, we will think what would be the value of the earnings if firm operates in a normal way. Then we consider it as then we will replace it as with the negative earnings value. But here the assumption is current year is not a normal year, and firm will come to this normal status quickly. Here we have to assume that the current year which has negative earning is not a normal year, and it will come to the normal status quickly. Let's say, for example, if the negative earnings is mainly due to a recession or economic downturn of a country, then the firm is impacted by that. So after the recovery, the economic recovery, firm will be in a normal status. So we can replace that particular year's negative earning with a positive value. Or we can normalize the earnings after the, if company negative earnings are due to the poor performance of the company due to the specific the venture related problems also. If venture thinks that they can overcome it quickly, then they can use this normalized earning approach. They can replace the negative value with a positive value. And then revenue and margin. Then instead of using earnings, projections can be based on the revenues and the margins. So normally revenue will not be a negative value, and we can straight away apply the operating margins or the profit margins to revenue value without considering much about these expenses. So once the venture makes the progress and improve its earnings to a positive number, then firm can use the more routine valuation methods. Then the third one is if the venture is reporting negative earnings due to high interest cost. That means if firm is reporting negative earnings because of high debt, the leverage, not because of any operating problem of the business, then as analysts we can adjust the earnings. We can adjust earnings by removing the impact of leverage from the earnings. So we can adjust the interest cost for that particular year. So these are the methods that we can use when we have negative earnings. Right. So I will further discuss about this normalizing earnings method, where we can use three methods to normalize the earnings. So in normalizing, what we would do is we would replace the negative earnings value with a positive earning value. So how we can do is we can use either average rupee earnings value over the particular time period. That means this approach is best if company have a history. That means in order to take an average, we need to have historical data. Therefore, when company have long history and especially if the scale of the business does not change significantly, if the scale of the business does not change significantly, then we can use this approach. We can get average value of earnings. And then the second method is we can take an average value of return on equity. So rather than taking a rupee value, instead of taking a rupee value, we can take a scaled version of earnings. For example, if we take return on equity, return is scaled as a percentage of equity. So it is not a rupee value. So we can calculate the return on equity of the particular firm for a time period and then take that average value to replace the earnings, negative earnings. And then the final method is using use of the current return on equity or margin of comparable firm. So for the earlier two methods, both methods, company should have a history and the stability to the business to use those two methods in order to calculate the averages. But when both of these conditions does not hold for another venture, then the available method is look at a comparable firm and take their return on equity, current year return on equity, to calculate the revenue, to calculate the earnings. Right, so again, I would like to recall that here we are replacing the current earnings with the normalized earnings. Therefore, our assumption is normalizing would occur immediately. So this negative revenue is is a temporary situation and firm would recover immediately. So that is our assumption. If normalization would occur at several periods, then we have to discount our selected value for those number of periods. So let's take this example. Let's take this example, and so this is a simple example. So DM reported a net loss of 35 million due to firm specific problems. Due to firm specific problems, and previous here the 4 years financial statements have been provided to you. It's not 3 years, it is 4 years financial statements have been given to you. Estimate the normalized earning value for year 2020 using average rupee method, average return on equity and return on equity of comparable firms. Right. So calculating the first method is easy, right? So what you have to do is calculate the average net income value. So quickly tell me what is the average net income value through the chat. What is the average net income value? It would be 38 million, right? So what we would do is instead of this negative 35, we would replace positive 38. So that means this 38 million is the net income that would generate by this company for year 2020 if it would operate in normal condition. Right? So we would replace this 38. So if we are calculating the net income based on the second method, what we would do? First, we need to calculate the return on equity for that particular company. Right? Here the book value of equity is given and net income is also given. So you can calculate the historical return on equity rates. So calculate and tell me what is the historical return on equity, average return on equity value for this firm. So what are the return on equity values for these 4 years? For 2016, it would be 23.45%, and for 2017, that would be 22.5%, and return on equity for 2018 would be 21.82%, and for 2019, 20.77%. Right? Then what we can do is we can take a average value. So here the average equity value would be the average value would be 22.76%. So historical average return on equity of this firm would be 22.76%. So now we can apply this rate to the given equity value of the firm. So equity value at the end of year 2020 is given as 225. So if firm wants to achieve a normal return on equity, average return on equity value of 22.76%, what would be the net income? So tell me, what is the net income value based on this method? So first you need to calculate the return on equity, the historical return on equity over the period of 2016 to 2019, and then get an average value. So what is the normalized earning value that you are going to replace this negative 35 million according to the second method? So we have already calculated the average return on equity. The historical average return on equity for this firm is 22.76%, and end of the year equity book value is 225. So we can multiply 225 by the equity value. So 22.76% into 225 is equal to 51.21 millions, right? So that means according to the second approach, the normalized earning value would be 51.21 million. So according to the first approach, the average value is 38 million. Now, according to this approach, we are going to replace this negative 35 million by positive 51.21 million. So if we are using the first method, sorry, the last method, ROE of a comparable firm, here what we would do is, we are not taking any average value. We are just taking the current year return on equity value of a comparable firm to estimate the net income of the selected venture. So here, the current year return on equity of the comparable firm is 18%. So according to the third approach, we would straight away calculate the net income value by multiplying this 225 million, the book value of equity, by this 18%. So according to the second approach, we are not taking any average values. We take the current year return on equity. Right? Current year return on equity of the comparable firm. Current year return on equity of a comparable firm, and multiply it by the book value of equity of the selected venture. So in case here, the 18% is the current year return on equity of the comparable firm, and our equity book value is 225,000. So 225,000. So based on this approach also, we would get a normalized net income value of 40.5%. So this approach can be used is more suitable. This approach is more suitable at which point? If firms does not have a history and they do not have a stable business. If firms does not have a stable business activities and they do not have much of a history, then we have to go for this third method, which is taking the current year return on equity of a comparable firm to replace the negative earnings value. So according to the three approaches, there are three values to replace this negative earnings value. Right. Then we will move on to the venture valuation methods. So I hope you all are clear with these three methods of the normalizing earnings. Right. When it comes to venture valuation methods, so valuation is quantification of the future vision of the venture. So even though the predicting the future of venture is difficult, so valuation is inherently about the future. So therefore, we need to quantify. We need to quantify the performance of the venture to our maximum possible extent. So therefore, if you are not using estimates, you are not doing a valuation. So of course, we need estimates of the financial statements, financial information of financial statements, and these statements should reflect the best guess about the future revenue, expenses, or any investment requirement. And basically, we have three methods. We can use three methods in venture valuation. One is discounted cash flow method. The second one is venture valuation method. And third one is relative valuation method. So we will discuss these three methods one by one. So moving on to the first method, the discounted cash flow method. The discounted cash flow approach means we are attempting to value the all future cash flows available to the venture. So when we are referring to cash flows, that means cash flows generated from the operating activities of the business. The cash flows generated from the operating activities of the business which are available for the venture. And then we would discount these cash flows by a discounting factor, a suitable discounting factor, which equals to the required rate of return of the investors. So that is how we normally take the value of any business. So here the special condition is, so when we are valuing a corporation, these investors' required rate of return or our discounting factor does not change, it remains constant. But when it comes to ventures, the required rate of return of the venture investors will vary according to the life stages of the venture. It will vary according to the life stages of the venture. Say for example, you will have learned that there are 5 life cycle stages to venture. The development stage, startup stage, survival, rapid growth and maturity. Right? So normally at the very beginning, the risk of at the early stages, the risk of the business is very high. Therefore, investors require a high return. But after some period, when the latter stages of the life cycle, at the latter stages of the life cycle, the risk is comparatively low. Therefore, investors will request a lower return. So therefore, over the time, the required rate of return or the discounting factor that we use to discount the cash flows will change in venture valuation. So we have to use different discounting factors for different life cycle stages to reflect the investor's view about the risk. Right? So at the initial stages, we have to discount the cash flows by a higher rate. At the lower stages, we have to discount the cash flows at lower discounting factor, using a lower discounting factor. Right. So, explicit forecasting period and the terminal value. So, you all know that in valuation, forecasting period, we can divide it into two. The explicit forecasting period and the beyond explicit forecasting period, that we call it as implicit period. Explicit forecasting period and the implicit forecasting period. So explicit forecasting period means it is the period where analysts can look into the future and predict or estimate the financial statement. Where the analysts can look into the future and estimate the financial statement. Normally for a venture, 2 to 10 years are the period which can be considered as the explicit forecasting period. So thereafter, beyond that period is considered as the implicit period. So normally until a venture becomes stable, we have to predict the variables that are needed to valuation yearly. Thereafter, when we come to the implicit period, then we can make certain assumptions, right? So this implicit period means here the cash flows beyond this explicit period. So the terminal value or the horizon value is the present value of cash flows beyond this explicit period. Present value of cash flows beyond this explicit period is called the terminal value. So you will have learned this in valuation as continuation value. And when we are calculating continuation value, you know we have certain assumptions about the growth rate. So we are assuming that the cash flows of the venture would grow at a certain rate, right? So either we can assume there will be a constant growth rate or a no growth or even the multiple growth rates. But normally for here we are assuming the constant growth rate. So that means uh, we assume that cash flows will grow at a constant rate forever. Right? The cash flows will grow at a constant growth rate in the implicit period. So this is the formula to calculate the terminal value. So if we are assuming the cash flows will grow at a constant growth rate, then those type of cash flows are considered as a growing perpetuity. So how do we calculate the present value of growing perpetuity? We take the cash flow and divide it by the required rate of return minus the growth rate. And this spread between the discount rate and the growth rate is referred as capitalization rate. Then the stepping stone year. So first year after the explicit forecasting period is called as stepping stone year. So that means if you are individually forecasting the cash flow values for 10 years, then the 11th year considered as a stepping stone year. So that is the first step into the infinite future. The first year of the implicit period is called as a stepping stone year. Then the reversion value, it is the present value of the terminal value. That means we take the terminal value, let's say our explicit period is 10 years. Then implicit period starts from the 11th year, right? So if we get the present value of all the cash flows beyond the 11th year, then we would get the present value at the end of year 10, right? So that value we should take again to the year 0. So that value is called the reversion value. So with the calculations you would understand this better. And capitalization rate we have already discussed, that is the spread between the discounting rate and the growth rate of the cash flows in the terminal period. And this is the discounted cash flow method, the normal here we take the cash flows and discount it by the different discounting factors. So shall we move on to the questions? The first question, so can you take 2 minutes and attempt on this question? What is the meaning of it? Assume that BB Marketing sells 20% of the ownership stake for 800,000 rupees for future payment of 5 million. So that means you have bought a 20% ownership of this 5 million at a price of 800,000. You have bought 20% ownership of this 5 million for the price of 800,000. So how do we calculate the implied return? It's a simple calculation. How do we calculate? So if we have 20% ownership of this 5 million means, what is our value of the investment after 1 year? What is the value of the investment after 1 year? We have 20% ownership to 5 million, right? So multiplied by 20%, that means you have 1 million worth of ownership, right? And you have bought it for a price of 800,000. So that means you can calculate the return, right? So implied return is equal to, first we need to take the profit. For that we need to multiply, we need to deduct the value of the investment after 1 year, which is 1 million, minus the purchasing price of the investment, which is 800,000, divided by the initial purchasing price. Right. So for this investment, you would have an implied return of, if we take it as a percentage value, you would have a implied return of 25%. Right. And then the second part of the question, how much the implied current value of B&B Marketing? Now they are asking the current value. So that means here the 20% of ownership is equal to 800,000. 20% of ownership is equal to 800,000. So that means what is the value of the firm now? So value of this entire investment. Value of the firm? Yes. It would be 4 million. And then the last part, what is the present value of the entire 5 million using the implied return? So that means you are required that, so we have already calculated that our implied return is 25%. So if the discount rate is 25%, what would be the present value of this 5 million cash flow after 1 year? So that means present value of 5 million, present value of 5 million at a discount rate of 25%, right? So 5 million divided by 1 plus 25% to the power 1, right? Simply you can divide it by 1 plus 25%. It is also equal to 4 4 million, right? So the present value of the investment it should be equal to the value of the firm today. Right. So moving on to the next example. Right. So moving on to the next example. So Kasun has estimated annual cash flows for the next 5 years for his restaurant business as follows. At the first 2 years, he has negative cash flows, negative 200,000 and negative 50,000. And thereafter, he has positive cash flows. So our requirement is if annual cash flows are expected to remain at 920,000 after the year 5. So that means in this example, right, explicit period is equal to 5 years, right? Explicit period equals to 5 years. So that means implicit period starts from the 6th year, right? So the stepping stone year is equal to 6, right? The 6th year is considered as the stepping stone year. And here it has given that the annual cash flows would not grow, it would remain constantly at 920,000. It would remain constant at 920,000. That means for terminal value estimation, they are assuming zero growth rate, right? They are assuming zero growth rate. So how do we value? So this is a simple valuation. So I would do this with you all. Right. So these are the cash flows. And 6th year is the stepping stone year, and there will be a zero growth rate, and discounting factor is also given. Kasun wants 50% rate of return for his investment. So that would be a discounting factor for these values. So first we can estimate the terminal value. First we can estimate the terminal value. So how do we estimate the terminal value? So after the first year, after the 6th year, there will be no growth rate. So there will be 920,000 worth of cash flows thereafter. So it is a perpetuity. So first we can get the present value of the perpetuity. Present value of the perpetuity 920,000 divided by the discounting factor. So present value comes at the end of the 5th year, right? Then we can calculate the discounting factor. Yeah, 1 divided by 1 plus discounting factor, which is 50% required rate of return, to the power 1. Likewise, we can calculate the discounting factor as well. Then we can get the present value of free cash flow is by multiplying free cash flows by the discounting factor. Then separately, we can take the present value of this terminal value as well. So that is what we call the reversion value. Reversion value. Present value of this terminal value figure. Here if we are taking the present value of this terminal value, that is called reversion value. So that means terminal value is counted by 50% for 5 years is equal to 242,305 is called the reversion value. Then you can get the summation to calculate the value of the firm, value of the venture. So which is equal to 104,432. Yeah. Now can you quickly attempt on the second part of the question? Here we are assuming that cash flows, here we are assuming that cash flows for the 6th year is forecasted to be 1 million. Instead of 920,000, now the 6th year value is 1 million and there is an expected growth rate. We take the second scenario. Here instead of 920,000 stepping stone year, the cash flow is equal to 1 million. And the growth rate, there is a constant growth rate which is equal to 6%. It is equal to 6%. So how do we calculate the terminal value? Terminal value would be equal to 1000 divided by R minus G. So here discounting factor is 50%, growth rate is 6%. So this would be your terminal value. And then like the previous example, we can take the discounting factors and we can calculate the present value. Here again the difference is the reversion value now is equal to 299,289. The value of the rent is equal to 462,470. Here our assumption is there will be a constant growth rate starting from the stepping stone year, that is equal to 6%. And then the third one, if the required rate of return of the investor will drop from 50% to 40%. So now the discounting factor is going to change to 40% instead of 50%. Beginning in year 6, to reflect the drop in operating or the business risk, what is the value of the venture? Right. Here again, let's assume that the conditions applied to the second part of the question remains. That means there will be a constant growth rate of 6%. So then the terminal value will equal to 1000 divided by the required rate of return is now 40% minus the growth rate of 6% will be equal to 2,941,176. So, so this is the value of the venture, right? 550,000 to 550,443. Yes. Yes, you all are correct that the 40% is applicable to the implicit period. That means when we are determining the terminal value, the discounting factor should be 40%, but for the explicit period, discounting factor is still the 50%. So I hope you all are clear with these calculations. I will continue this lesson, and there will be a second part of the lesson as well from the next week.